One wrong move after you apply for your mortgage and it's gone. The house you've made plans for, no longer yours. Not denied at closing because the house had a problem. Denied because you did something nobody warned you about. Here's the part that gets me. Most buyers who lose their approval never saw it coming. Nobody sat them down and said, hey, here's what not to do for the next 30 to 45 days. So they made a totally normal decision and blew up their loan. Hi, my name is Katie Payne, your local Kansas City real estate agent. I specialize in military relocation. And today I want to talk about what not to do between contract and close. We will cover the 3 things that kill mortgage approvals and exactly how to avoid every single one of them. I'm also throwing in a bonus 4th mistake I see constantly, what to do if you're reading this too late, and a special section for my VA buyers because there are a couple of extra landmines during a PCS. You got pre-approved, you're excited, you go buy the couch, the truck, the new laptop, we're moving in, might as well. Stop right there. Every time you open new credit or finance a big purchase, your lender sees it because they pull your credit again right before closing. It's called a soft pull or a credit refresh, and most buyers have no idea it's even happening. That new car payment, it just changed your debt to income ratio. And if it pushes you over the line, your loan officer may have to shrink your loan amount or lose the approval altogether. Let me make this concrete. Say you're approved with a $450 monthly car payment already in the mix, and your debt to income ratio is sitting right at the limit your loan program allows. You go finance the new truck at $600 a month because your trade-in fell through. That's not a small bump. That can be the difference between approved and denied, even though your income didn't change at all. This includes things people don't think of as credit, furniture financing, that 0% APR offered at the appliance store, even opening a new credit card for the sign-up bonus points on your moving expenses. All of it shows up, all of it counts. Even if you don't carry a balance, the mere act of opening the account can ding your credit score and shift your ratios. And here's one people really don't expect: co-signing for someone else. Co-signing your kid's car loan or helping a sibling get an apartment puts that monthly payment on your credit report, whether or not you're the one paying it. Underwriters count it against you unless you can prove someone else has been making those payments for months with paper trail to back it up. The second risk is changing or leaving your job. This one surprises people because it's not always a bad thing that trips them up. Got promoted, switched to commission pay, decided to finally go self-employed, all great life moves, all potential landmines for underwriting. Lenders aren't just looking at whether you have income. They're looking at whether that income is stable and predictable. A job change, even a lateral one, can reset the clock on how much history they need to verify. Here's how this actually plays out. If you switch from a salary job to a commission or bonus-based pay structure, most lenders want to see 2 years of tax returns showing that income before they'll count it towards your approval, even if your new job pays more. Same story if you go from being a W-2 employee to 1099 self-employed. You might be making great money, but if you can't show 2 years of self-employment income, a lender often can't count it at all. That's not the lender being difficult, it's the loan program's rules. Even staying in the same field but switching employers can trigger extra conditions: a verification of employment call, an updated offer letter, sometimes a full re-underwrite of your file. I've seen closings pushed back 2 to 3 weeks over something as simple as a start date confirmation letter that took longer than expected to get from HR. The fix isn't never make a career move. Career moves are how people build wealth. The fix is knowing the timing and loop your lender in the moment it's even a possibility, not after you've already signed the new offer letter. Hazard number 3, moving large amounts of money. You get a gift from your parents for the down payment. You sell some stock. Your buddy pays you back for that trip. Totally normal life stuff. To an underwriter, it's a question mark. Any large or unusual deposit, and large can be anything that stands out compared to your normal account activity, needs to be sourced and documented. Where it came from, why, and proof that it's a gift or a repayment and not an undisclosed loan you now have to pay back. Picture this. You deposit $8,000 from a family member 2 weeks before closing to beef up your down payment. Without a gift letter and a paper trail showing where that money came from on the giver side, your lender may have to exclude those funds entirely from your approval, which can mean you're suddenly short on cash to close, days before your closing date. Even moving money between your own accounts can trigger questions. Consolidating 3 savings accounts into one right before closing, for example, can make it look like new money appeared out of nowhere, even though it's all yours. The lender doesn't know that unless you show them. And one more version of this that catches people off guard: cash. Large cash deposits are one of the hardest things to document because there's no paper trail showing where the cash came from. If you sold something at a garage sale, got paid back in cash for a personal loan, or just prefer keeping cash on hand, talk to your lender about how to handle it well before you deposit it. Talk to your lender. I can't emphasize that enough. Now, here's your bonus mistake I promised: applying for store credit or buy now, pay later. This is the one nobody talks about, and I'm seeing it constantly. Buy now, pay later services. Think Affirm, Afterpay. They feel like they're not real debt because there's no credit card involved. But depending on the lender and the loan program, these can absolutely show up and factor into your approval, especially if you stack several of them for furniture, appliances, or moving expenses all at once. Same goes for those in-store financing offers for a new mattress or a living room set timed perfectly for your move-in date. It's the same mechanism as Section 1, new debt, new monthly obligation, new scrutiny, just wearing a friendlier outfit. If you're using a VA loan or you're in the middle of a PCS, a couple of these mistakes have extra layers. First, BAH and orders matter. If your orders change, get extended, or your BAH rate shifts because of a change in duty station or dependents, your lender needs to know immediately because BAH is counted as income on a lot of VA loan files. A change there can actually affect your qualifying income, not just your debt. Second, timing your PCS around your closing date is its own kind of financial stress test. Moving expenses, temporary lodging, storage fees, all of that can tempt you into exactly the kind of spending or borrowing we just talked about, right when your file needs to look the most stable. If you're PCSing into or out of Fort Leavenworth, build a little cash buffer for the move itself so you're not tempted to finance a U-Haul's worth of furniture on a store credit card 2 weeks before closing. For my military folks moving back from overseas, if you're planning to buy a car as soon as you get back to the States, check with your lender before heading to the dealership. If you're watching this and thinking, uh-oh, I already did one of these, don't panic and don't hide it. The worst thing you can do is stay quiet and hope your lender doesn't notice. Call your loan officer today, tell them exactly what happened, and let them tell you what documentation they need. Most of these situations are fixable with a letter of explanation or extra paperwork. It's the surprises that kill deals, not the mistakes themselves. Here's the simplest advice in this whole video. Before you do anything financial during your home purchase, a purchase, a job change, moving money, call your lender first. One 5-minute phone call can save you weeks of stress or save your entire approval. Your lender isn't the finance police. They're on your team. Use them. Until you have keys in hand, treat your finances like they're frozen in time. Same job, same accounts, same spending habits you had the day you applied. Boring is good right now. Boring gets you to the closing table. If you're just starting to think about buying in the Fort Leavenworth area or anywhere in the KC Metro, this is exactly why you want someone in your corner from day one. I'm not going anywhere once you're under contract. I'll be watching out for your interests every step of the way, so you're never caught off guard by something like this. Drop a comment or send me a message and let's get you started. Thanks for watching, and I'll see you soon.